Hello and welcome to Currency Point, presented by me, Evan Lucas for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature. None of it should be relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It is just general in nature only. Who's right? We've always been having this discussion about who is right. Is the bond market right or are central banks right? And what's becoming probably apparent from the end of last week and the FOMC board meeting and their release statement, and it's not just for the FOMC, it's probably for all central banks at the moment, is that maybe actually they're both right. And what we're starting to see, and what I mean by that, is that if you start to actually look at where all the action is happening, it's in the back end of the curve. Listen to what the Fed, what the RBA, what the BOE, BOJ, take your pick, they're all talking about the front end of the curve. And why I want to highlight that and what you really want to look at is, if you look in the US at maturities or durations of 5 years or less on an implied real yield basis, they've actually gone backwards. Everything out past that has gone up. Now, what you're also taking from that and listening to the Fed, because yes, last week what also caught people's attention, they upgraded their GDP forecast for 2021 to 6.5% from 4.2. If you have a look at the unemployment rate, it's supposed to be back below 5. And then the big one is that they expect CPI to be above 2% at 2.4% come December. So all of that suggests that we are getting really stellar economic numbers and that inflation is coming, the reason to raise rates. What they're suggesting though is that they are very happy right now to allow the back end of the curve to steepen. That's what they expect, it's what they know, and that the tightening of policy at the back end will happen and will have to happen to bring inflation back into their line. But right now, all they are focused on is the pandemic and the outcome of the pandemic, and that's all it is. We haven't heard anything about Operation Twist, no YCC, so yield curve control, as we have here in Australia, none of that. They're not worried about that at all. In fact, what they're basically suggesting is that they're pretty happy with how things are going and are moving in a way that is the right thing for them. Only 7 members expect rates to rise in 2023. And of those 7 members, it's expected only 1 of them is voting. And there's only 4 that think rates could rise next year. So we're 2 years away from seeing rates rise. Why I highlight all of this is because the discussion we're having is that realistically then, everybody's right. It means that the bond market is correctly probably pricing in inflation and that the 10-year, 15 and 30 will see rate increases. That's a given. We know we can't have this pandemic expansion that we're currently having forever. So that's the trade. And we've been talking about that. But why that matters is if you start to have a look at some of the transactions that are going on and the correlations, have a look at the written work I've done this week. Those correlations are incredible. So you look at Dixie and you can see it's pretty close. Start of the year, it's been, basically as the 10 years gone up, Dixie's gone with it. In the last month, it's got tighter, that correlation. But I remain really strong, and it's not a currency I've always been a real, believer in because it is difficult, and that's dollar yen. But dollar yen is lockstep in terms of what's going on. They are, since the start of the year, as 10 years have risen, dollar yen's gone with it. As 10 years have fallen, dollar yen's gone with it. And we saw that on Thursday. We actually saw yields fall off about 7 basis points. We saw dollar yen go from about 109.25 to 108, as low as 108.07. Realistically, it was probably about 108.25. But since then, and since yields went back up, bang, straight through 109. And there's every chance it could be at 110 pretty quickly. If you, again, getting back to my argument at the start of this, which is that rates are going to rise, and they're going to rise over the next 10 years, 2% on the US 10-year, it's not hard to argue in sometime in the next couple of months, and therefore dollar yen's going to go with it. So there is a long bias to it. And that's, I think, at the moment, the best way to be trading is to actually find the correlations, find the relationships, and go with them because they're clearly working.